Bruce Preser Daily Mortgage Market Update. Today is Friday. Once again, we go to the mortgage bond chart. You can see that mortgage bonds yesterday able to hold on to some of their gains. Now, today you can see that we're still 9 basis points higher than where we closed yesterday. That being said, as you can see by this candlestick, today we have traded up significantly higher. We are well off our best levels of the day so far. Now, I've been talking all week long about the importance of today's jobs report, so let's get right to it and look at the economic calendar. Today, we learned that in May, the government created, or the economy created 217,000 jobs. Now, this was pretty much right in line with the expectations of 220,000 jobs created. Last month's number was revised down, but only from 288 to 282, so no big revisions from last month either. So all in all, this headline number pretty much coming in line with expectations. The unemployment rate held steady at 6.3% when the market was expecting it to potentially take a slight jump to 6.4%. I want to talk a little bit about the labor force participation rate because it remains steady at 62.8%, which is still the lowest labor force participation that we've had going all the way back into the 1970s. So our labor force is still very small in relation to the number of people out there who could be working. So when you look at this jobs report, you say, yeah, these numbers came in line with expectations. And quite honestly, I think the market's somewhat taken a little bit of a sigh of relief today, a deep breath here, because the last few jobs report have really been a little bit crazy. We've seen very big swings in the jobs number, the unemployment rate, numbers going in opposite directions of what you normally think. And so the market's today somewhat getting back to what we would consider a more reasonable jobs report. I also want to point something out, though, and I talked about this a little bit yesterday. Initial jobless claims, as of yesterday's number of 312,000, are at their lowest level now in the recovery. That 4-week average is now down to 310,000. What we still are not seeing is a initial claim number, a much lower initial claim number. We're not seeing that translate to significantly greater jobs growth. And this is very important, folks, because jobs growth, jobs is what creates, it's the wheel of our economy. It's what gets things going. More jobs means more people working, which means more money to spend, which means higher tax base, which, it all filters down. And that's why this payroll report is the granddaddy of all economic reports we receive every month and why we pay so much attention to it for mortgage rates and where things are headed, because jobs is really what it's all about. We have to have good, high-paying, skilled positions in order to grow this economy. And while this is not a bad jobs report, this isn't a good jobs report either. I mean, it's in line with expectations, but this is not enough to get us out of this slow, stagnant, kind of go nowhere type of thing that we seem to be stuck in right now. We need stronger jobs growth if we're going to get this economy to get a real kick in the butt and get going. Let's look at next week's economic calendar. We're going to have a series of 3 Treasury auctions next week. We don't have a ton of stuff on the table really until we get to Thursday and Friday of next week, is when we're going to get the important stuff. Initial jobless claims, retail sales. Folks, next to jobs, retail sales is one of the things I really keep a close eye on, because retail sales tells us are people out there spending money. Remember, our economy is driven by consumer spending. Over 66% of our economy is based on consumers out there spending money. And again, one of the reasons jobs are so important. This retail sales for May is going to be a very important number to watch, so that's going to be very closely monitored next week as far as where rates could go. And then we're going to get PPI. Now, PPI also a read on inflation. PPI is wholesale inflation. Wholesale inflation doesn't always translate to consumer-based inflation. Consumer-based inflation is more important for mortgage interest rates. We will get the CPI, or Consumer Price Index, and PCE coming up here in a few weeks. Those are the Fed's consumer inflation-based looks. On Friday next week, we're also going to get the University of Michigan Consumer Sentiment reading for June. So while next week isn't a huge week as far as data, there is nonetheless some important data at the end of the week, and then we got those Treasury auctions mixed in there. This week, overall, you look at the wind-up of the calendar, a lot of mixed data overall. But that being said, we got through this week pretty good. Mortgage bonds have been on a tear. We've been on this big rise. In case you haven't caught some of my updates over the course of the last week or two, I want to go ahead and I want to draw the mortgage bond chart out here for you. I want to just show you. This is looking at the last year of mortgage bonds. You can see that last week we touched this level up near 103.50, which takes us back all the way to June of last year before we were at those same levels. So we touched last week our best levels in a year. But you can also see when we had that big slide in mortgage bonds that lasted all summer long, that's why interest rates took that huge jump last year, Then by fall, we had had some recovery, although not nearly as high as, and this only goes back a year. So if you'd have gone to April or so, you'd see things would be even higher here. Mortgage bonds did a nice recovery before, again, falling off and then starting another recovery, fall off, and then this line, this channel that we've been in here, let's say going back since March. We've been in a nice run back up to higher mortgage bond prices. Obviously, the question, if you're a home buyer, you're selling your home, you're looking to refinance your mortgage, anything like that, is are we going to continue to see higher interest rates? And the answer is, um, uh, or I should say higher bond prices and lower interest rates. And the answer is maybe. We may yet still not have seen the lowest rates we're going to see this year. That being said, I can promise you that we're going to see higher interest rates at some portion down the road, somewhere near here in the next, it could be the next week, it could be the next few weeks, we're going to see higher rates because as mortgage bond prices fall, rates go up. When we're so close to the top of the chart that we've been at in a year, you can't expect things to keep going up, folks. So what we do know right now is, will rates go down? The answer is a big fat maybe. Will they go up? The answer is an absolute assured yes. This is not a time to get greedy. This is absolutely a time to take advantage of some of the best pricing we've seen in over a year. If rates do get better before you close on your mortgage, you take advantage of our float down program. It doesn't cost you anything. Locking your rate simply caps you. You still have the opportunity to take a lower interest rate. But on the other hand, if you're locked and the market does go back south, like we've seen happen in the last week, folks, if you'd have locked your loan last week versus locking your loan a couple days ago or even today, you would have had better mortgage pricing than you're going to get. So that's because mortgage bond prices fall. As that happens, rates go up. Do not try to time the markets. It does not make sense in a volatile market like this, and it especially doesn't make sense when you've got rates at near their best levels in an entire year. Take a look at this chart. Take a look at how much time we've spent down in these levels versus these levels, and I hope that clearly illustrates to you that right now is a very, very wonderful and opportune time to take advantage of a market that may not last for a week, let alone another month, 2 months, 3 months, or who knows how long. So this is where we are heading into next week now. Again, the economic calendar next week, not nearly as big. The real data is going to come Thursday and Friday of next week. But in the meantime, we will have plenty of other data, including Fed speakers out there. We're going to have Treasury auctions next week, things that could still rile the mortgage markets and send things one way or another. So be very, very careful if you're out in the market, floating the market right now. Again, this is not a time to get greedy. I really think it's a great opportunity to take advantage of, again, some of the best pricing that we've seen in over a year. So this is where we are heading into the weekend. Of course, I'll be back with you next week with more updates. I will be traveling next week, so it's going to be a little bit more difficult for me to get my updates out. I will do my best to get them out near the same time every day. There could be a day or two next week that is missed. I just want to let you know up front that next week's going to be a little bit more difficult for me as far as being able to get the updates out. Have a great weekend, and if I can help you in any way at all, please don't hesitate to contact me. All my information will be here.